Welcome to the show. Today we are strapping on our systematic trading helmets for a really granular look into a system designed, and I'm quoting the creator here, to eliminate market guesswork.
Yeah, this is a big one.
We are unpacking the entire blueprint of something called the Reserve of KING-KAMBUF Financial News and Reports magazine, weekly market digest and investment analysis. Specifically, we're looking at the T-KIFE MA Ribbon Strategy System by KING-KAMBUF.
And what's so fascinating is the set of sources we have. I mean, we're not just looking at an indicator file. This is an entire educational ecosystem.
Right.
We've got the Pine script logic, the sales copy, the whole curriculum, and, what I think is most critical, a curated reading list that really grounds the system in established principles.
Okay, so let's unpack this for you, the listener. Our mission today is to really understand how you can move from, just feeling the market from gut predictions to implementing a rigorously defined structural framework. We're going to expose the whole T-KIFE blueprint. I mean, everything from the technical specs of their unique 10-layer moving average ribbon all the way to the precise rules for execution and risk.
And the core promise of this system is really just one word: structure. It's all built around identifying the trend regime, filtering out market noise or chop, and then timing these high probability entries at defined structural points. And maybe the most important part is managing risk with structural rules, not just, arbitrary percentages.
It's about replacing that subjective charting with a repeatable checklist.
Exactly, an automated checklist.
And this is where it gets really interesting right out of the gate. I mean, most trading systems you see out there, they use 2, maybe 3 moving averages, a fast one, a slow one.
Sure, the classic crossover.
The T-KIFE system uses 10. 10 distinct moving averages, and it's this really exhaustive set, the 5, 10, 20, 50, 90, 120, 200, 270, 350, and 500.
It's a lot.
So the big question is why? Why such complexity? We really need to figure out why they chose this specific set of lengths and, how each layer contributes to what they call this market structure map.
That's the question we have to answer first, because usually, just adding more lines to a chart, that's a recipe for disaster. It's just cognitive overload.
Nodal analysis paralysis.
But here, the goal isn't complexity for its own sake. It's about completeness. They're trying to capture market behavior across every single relevant time horizon, which forces you, the trader, to respect momentum, inertia, and that deep history all at the same time.
Okay, so let's start right there with the foundation, this 10-layer moving average set. Now, we noted they default to the simple moving average, the SMA. Is that just for simplicity, or is there like a strategic reason for picking SMA over, say, an EMA?
It's a strategic choice, really. It's built on calibration. The system does let you switch to EMA or RMA, but SMA is the baseline because it reacts in a very linear, consistent way to price. And when you have 10 of these things stacked up, that linear response makes interpreting their 4 ribbon laws, order, slope, spacing, and location, it makes it cleaner. It's less prone to the weird nuances of exponential smoothing.
So the defaults are locked in for a reason. They're all calibrated to work together.
As an integrated whole, yeah. Measuring everything from, microsecond noise all the way up to that deep historical gravity.
So these 10 lengths aren't random. They're grouped into what they call 3 gears of the ribbon. Let's start with the fastest ones, the fast MAs. The 5, 10, and 20. What's their main job here?
They're basically the timing and pressure signals. You should think of them as the market's pull.
A pulse, okay.
The 5 and 10 are used almost exclusively for the trigger logic. They signal that little shift in momentum you need to confirm a continuation after a pullback. They have to be fast enough to catch the start of that new impulse.
And the 20.
The MA20 is a bit different. It's used as the sort of minimum short-term support or resistance line. If price can't even hold the 20, a short-term trade is probably going to fail. These 3 are just critical for entries and for the fastest exits.
Okay, so if the 5 and 10 are the pulse,
then
the medium MAs, the 50, 90, and 120, they must be the swing structure itself. I mean, we see the MA50 everywhere, but what do the 90 and 120 really add to this?
Well, the 50-day is the standard, right? It's the measure of short-term institutional health. And here it serves as that crucial dividing line between a normal, healthy pullback and something deeper, something that could be a regime change.
Right.
The 90 and 120 just extend that concept. They provide a deeper layer of structure for those key pullback zones. The MA120 specifically has a dual role. It's the outer boundary of that medium-term structure, but it also pairs up with the MA200 to define the long-term regime engine.
That's interesting. So they're building these multiple layers of support to define what a safe tradable pullback actually looks like. A pullback to the 50 is standard.
Yep.
A pullback to the 120, that's a deep test. But it could be a really high reward entry if it holds.
Precisely. They're grading the market's commitment. And then you jump to the big ones, the long MAs, 200, 270, 350, and 500. This is where the system's depth really shows.
I mean, the MA200 is famous. It's the classic bull versus bear line. But why drag in a 270, 350, and 500? Isn't that just overkill for a swing trading system?
That's a valid concern, and it goes back to that market structure map philosophy. The 120-200 pair defines your actionable regime, your permission to trade.
Okay.
But the 270, 350, and 500, they provide context. They define the structural gravity. For a swing trader, just knowing that an asset is trending above its 500-day average, that provides this profound psychological reinforcement.
So it tells you the trend isn't just temporary.
Exactly. It's deeply persistent. It's probably institutional grade. They act as filters for only the highest conviction setups. A trade you take when all 10 MAs are perfectly aligned is just statistically healthier than one where the long-term MAs are fighting back.
So these really deep MAs are just confirming the macro environment, making sure you're not trying to, long a stock that's still fighting some deep historical resistance, even if the 120-200 pair looks okay for the moment. It's all about context.
It's all context. And once you have this 10-layer foundation, the system gives you the T-KIFE language to assess the trend's health, and it's laid out as these 4 fundamental laws for reading the structure.
Right. This turns the visual mess of 10 lines into an actual diagnostic tool.
It does.
So the first law is order, or stacking. This seems like the simplest one, but also the most important. What does perfect stacking say in a bull trend? What does that actually signify to the system?
Perfect stacking just means every single time horizon is aligned, from the quickest pulse, the MA5, to the deepest history, the MA500.
So 5 is greater than 10, which is greater than 20, all the way down.
All the way down. Perfect order signifies maximum agreement, minimum internal friction. If you see disordered stacking like the MA50 is above the 90, but it's below the 20, that immediately tells you there's internal structural weakness.
A transition phase, maybe?
A transition or a deep consolidation, yeah. The market is basically eating itself from the inside out.
Okay, the second law is slope, the direction. A flat line is the enemy here, isn't it?
A flat slope, especially on the medium and long MAs, is the system's early warning for indecision and, critically, for impending chop.
Right.
A rising slope across those key MAs, the 20, 50, 120, that signals power and conviction. The system wants you to prioritize stocks where those MAs are marching decisively up or down.
You want the trend to be steep enough to give you that statistical edge.
Yes. The third law is spacing, which defines the trend's health. And this connects directly to the system's chalk detection. Expanding space means acceleration, right?
Right. So what does contracting space or compression, what's that a warning sign of?
Contraction is the sign of trend exhaustion. It means the market's velocity is slowing down and all those moving averages are starting to converge on the price.
And that convergence is the braided ribbon.
That is the definition of the dreaded braided ribbon phase. It signals a major structural shift or consolidation is coming. Expanding space means momentum is building.
And the final law is location? Where is the price sitting relative to the ribbon? I think the sources said something like the ribbon is the structure and the price is just the data.
That's right. Location assessment is about judging how safe the current price action is. In a bull regime, if the price is sitting nicely above the MA20 and MA50, it confirms that higher prices are being accepted. The structure is healthy.
But if it starts slicing through the medium MAs?
If price starts penetrating the 50, 90, 120, that location is a warning that the trend is under severe stress. You should be tightening stops or looking for an exit.
And that idea of viewing price itself as the one-day MA, that's a really helpful teaching tool, isn't it?
It's brilliant because it demystifies the candlestick. It forces you to see the current price not as some emotional event, but just as the most recent data point being measured against the weight of history.
And the ribbon is the history.
The ribbon is the collective historical consensus of the market structure. The candle is just that day's vote on value. And this whole foundation, it just sets the stage for how they rigorously define the regime.
Okay, so we've mapped the structure with the 10 MAs and the 4 laws. The next logical step is figuring out which direction we're even allowed to trade. This brings us to the regime engine, the T-KIFE permission to fight rule.
Yeah, and this systemic reliance on a fixed binary state bull, bear, or neutral, that's probably the most important part of any systematic strategy.
It takes the emotion out of it.
It removes the biggest source of retail trading error, fighting the long-term trend. The T-KIFE system uses a very specific pair for this, the MA120 and the MA200.
Okay, so why the 120-200 pair? Why not the more common 5200 cross? I mean, that's the golden cross everyone talks about.
That's a great question. The 5200 is fantastic for defining a really deep structural regime change. But the 120-200 pair, it offers a potentially more responsive definition of that intermediate to long-term trend without picking up too much short-term noise.
So the 120 is about a 6-month average.
Exactly. By requiring the 120 to lead the 200, the system ensures the trend has been established for about half a year. But it still lets you catch moves that might start before the 50-day has fully made that golden cross. It defines a high-conviction intermediate structure.
Let's nail down the technical definition of the regime. We're talking about the system's strict mode. What are the two non-negotiable conditions for a bull regime?
Okay, condition 1 is the stacking rule. The MA120 must be clearly greater than the MA200. That's the foundation. But the critical filter is condition 2, the slope agreement. The MA200 must be rising MA200, MA2001.
That second condition feels absolutely essential. Why? Why make sure that the slowest, heaviest anchor, the MA200, is actually rising?
It prevents you from taking trades in a trend that is already topping out, flattening, or rolling over.
I see.
Imagine a scenario where the 120 crossed the 200 6 months ago. Bull trend. But now the market's just going sideways and the MA200 has gone flat. If you only use the stacking rule, you'd still think you're in a bull regime, but the momentum is gone.
So this makes sure the trend has current conviction.
Yes. By demanding that the MA200 shows upward motion compared to the previous bar, the system filters for trends that have genuine power right now.
And the bear regime is just the inverse. 120 below 200 and the 200 falling. If neither of those clear states is met, it defaults to what they call the dead zone or neutral transition state.
And that neutral state is the market's stay-out sign. The importance of this rule, which they pull from all that systematic trend-following literature, is that it dictates the side you are allowed to fight on.
Right.
If the system flags bull, you are physically restricted to only looking for long entries. You can't be tempted by a short, even if it looks good, because you're violating that long-term structural permission.
Okay, so once we have permission, the next firewall has to be detecting the market's biggest capital destroyer. CHOP. This brings us to the CHOP detector, the no-trade law.
Because chop markets, where price is volatile but directionless, that's where trend followers suffer their biggest drawdowns. The system aims to remove most of those losing trades by using a mathematical filter that just says, if the structure is compressed, the edge is gone.
Let's dive into the technical formula for that primary braid condition, because this is where the precision is. It's triggered if the space between the MA20 and MA50 is too small. Specifically, MA20, MA50, close braid threshold.
Right.
Let's break down the logic behind that calculation.
We have to focus on why they divide by the close price. That's the crucial part. It's for normalization.
Okay.
If we just measured the absolute dollar difference between the 20 and 50, a $5 difference means nothing for a $500 stock, but it's extreme compression for $10 stock.
Right.
By taking that absolute difference and dividing it by the current closing price, the system measures the ribbon compression as a percentage of the current asset price.
So it's normalizing the measurement across different prices and volatilities.
Yeah.
So if the 20 and 50 MAs are less than, say, 0.5% apart, the default, the system flags it as too compressed, whether you're trading Bitcoin or some small cap stock.
Exactly. It's an objective definition of structural weakness. It prevents that subjective reading of, it looks a little tight. It either is or it isn't.
But the sources also mentioned a secondary filter, an optional one, the cross-chop counter. What's the purpose of that?
The counter is designed to catch instability before full compression happens. The system uses a look back, usually 20 bars, and it just counts how many times the prices cross back and forth over the MA20 in that window.
So you might have a situation where the 20 and 50 are still, say, 1% apart, so technically not braided.
Right.
But the prices crossed the MA20 5 times in the last 10 days. The cross-chop counter would flag that instability and say, hey, even though the structure isn't fully compressed yet, the price action is way too messy to trade.
Precisely. It's a robust protective layer, and you get these very clear alerts, chop on, braided, and chop off clearing. Before you even look for a signal, you have to pass those 2 high-level tests. Is the regime correct? And is the battlefield open? If the answer to either is no, you walk away.
So we've mapped the structure and we've established the permission boundaries, but, not all bull markets are the same. This brings us to the quantification engine. the ribbon score from 0 to 100.
Yeah, and this is explicitly designed to help with that 30-second chart scan. It helps you prioritize the few elite trend health setups from, hundreds of possibilities.
It's a critical tool for systematic scanning.
It really is. It digitizes what would otherwise be a subjective visual assessment. Instead of you saying, this trend looks pretty clean, the system gives you a number. It lets you filter a whole watch list down to only the tickers with the cleanest, most aligned structure.
It ranks the setup quality.
It ranks the quality.
The score is split into 4 equally weighted parts, 25 points each. Let's dissect this, starting with a regime score.
This is the foundation. If the ticker is in a confirmed bull or bear regime, following all the rules we just talked about, it gets the full 25 points. If it's in that neutral state, it gets 0.
That's aggressive weighting.
It's entirely intentional. The system is only designed to work when a clear, confirmed long-term trend is present. By making this 25% of the total score, it heavily penalizes you for even thinking about trading sideways or counter-trend moves.
It aligns perfectly with that regime is permission philosophy.
Right.
Okay, next up, the stacking score. 0 to 25, which measures the internal alignment. How do those points break down?
So the 25 points are split across 5 key moving average pairs. Each one is worth 5 points. You have MA 5 over 10, 10 over 20, 20 over 50, 50 over 120, and 120 over 200.
So it's checking alignment from the very short term all the way up to the deep structure.
Exactly.
So what does a score of, say, 15 on the stacking component tell me?
A score of 15 means 3 of those 5 pairs are correctly stacked. So for example, the crucial medium to long-term structure might be perfectly aligned. 50, 120, 200 are all good. But the short-term MAs, the 5, 10, and 20, they might be all tangled up.
I see.
It tells you the overall structure is fine, but there's short-term internal confusion. So you should probably expect a volatile entry or a messy pullback. It's instant diagnostic info.
Okay, moving on, we have the slope score, which rewards that directionality and power.
Right. This score focuses on the slope of the key structural MAs, 20, 50, 120, and 200. Each one of those sloping decisively in the direction of the regime earns 5 points. This is checking for conviction. Is the MA20 your short-term support? Is it actually moving up, or is it flat? If it's flat, you lose 5 points right there.
And there's a crucial 5-point bonus in there, too.
The bonus is for agreement between the MA50 slope and the MA200 slope. This rewards synchronized strength. If the medium-term health, the 50, and the long-term gravity, the 200, are both accelerating in the same direction, it validates the trend's power. It suggests synchronized institutional participation, not just short-term speculation.
And finally, the spacing and health score.
Mm-hmm.
This basically grades how far the market is from that chop detector threshold.
This is the reward for expansion. It gives you 10 points if the gap between the MA20 and MA50 is wide enough so it's not braided. Another 10 points if the 50 to 120 gap is also expanding.
Okay.
And the final 5 points are given if the price has consistently stayed on the correct side of the MA50 over the recent past. That ensures stability.
So this component makes sure that even if you have perfect stacking, you won't score highly if all the MAs are just mashed together. You need space to breathe.
Precisely. Compression kills trends. And by quantifying this, the system gives you clear labels. A score of 90 to 100 is elite trend health. 75 to 89 is tradable, clean. Anything under 60 is a no-trade zone.
And the practical application here is huge. If I filter my entire watch list for a score of 75 or higher, I'm instantly removing all the messy, transitioning, compressed stocks. I'm only looking at tickers that have already passed the structural checklist.
That's the power. It enables that 30-second scan. It quantifies the human ability to assess structure. And think about the psychological benefit. You are now guaranteed you are only executing trades on assets where all the structural elements are fundamentally aligned.
Structure defined, permission granted, quality ranked. Now we execute. The system's philosophy is really clear on this. Don't chase, wait for price to come back to structure. The flagship setup is #1, the continuation pullback.
Yeah, and this setup is prioritized because it just maximizes the statistical edge of momentum. You're trading at the prevailing force, but you're getting in at a tactical, reduced risk price level.
You're buying strength on discount.
That's it. Buying strength on discount.
The system defines specific zones for this. In a bull regime, the long zone is the optimal buying area, defined as the close being between the MA20 and the MA50.
Right. That 20/50 channel is the system's sweet spot for a healthy pullback. If it goes deeper than the 50, you're getting into structural stress. If it doesn't even touch the 20, you might be chasing. But they also include a very important proximity rule.
Oh, what's that?
The long zone is also active if the close is within a 0.5% proximity of the MA50.
Why that little inclusion?
Because sometimes, especially in really strong trends, the pullback might just kiss the MA50 and bounce violently without ever really entering that 2050 channel.
The touch and go.
That proximity rule makes sure you don't miss those powerful bounces just because the price was a few pennies outside the defined channel.
So being in the zone is the setup ready alert, but that's not the entry. The system needs a precise trigger plus a confirmation to make sure the selling pressure is really over.
This is the filtration layer against catching a falling knife. The long trigger is the first sign of life. The short-term momentum flip, which is defined by the MA5 crossing up over the MA10.
Okay, that signals immediate upward pressure is returning.
Right. But the truly essential filter, the thing that prevents false triggers, is the confirmation, or what they call the reclaim rule. The close must be greater than the MA20 on the same bar as the trigger.
The reclaim rule seems to be the system's genius for avoiding traps.
It is. A 510 cross can often fire way too early while price is still sinking. If you just entered on that, you'd be buying into continued weakness.
I've done that.
We all have. The requirement that the price has to reclaim the MA20, that minimal short-term support line before you enter, ensures the asset has proven it can hold its ground. You're prioritizing certainty over catching the absolute low.
Okay, let's walk through a quick hypothetical. Asset X.
Okay. Asset X has a ribbon score of 88. Clean. Regime is confirmed. Bull, we see the price start pulling back, it dips below the MA20, and it settles right at the MA50.
At this point, the setup ready long zone only alert fires. We put it on our watch list. Now what?
We wait. The next day, the candle moves lower, but then it rallies aggressively. As that bar closes, two things happen at the same time. The MA5 crosses up through the MA10. That's the trigger.
And the close prices say 101.1, which is above the MA20 at $100.05. That's the confirmation.
And boom! The system fires the setup triggered long entry signal. That is your moment of execution. You buy, knowing you have structural permission, high trend quality, and confirmed momentum reversal, all filtered through objective rules.
It removes the gut feeling. The alert becomes the final step in a checklist, not the starting point.
Exactly.
And while the continuation pullback is the bread and butter, there are two other setups. Briefly, setup #2, the breakout and retest. Why is the retest so important to a system like this?
The breakout retest, or buying the second mouse, is key because it demands proof that the newly broken resistance level has actually become structural support. Chasing the initial fireworks is what amateurs do, waiting for the pullback, watching the structure hold, and then buying the confirmation. That's institutional trading.
And setup #3, the bottoming reversal. The curriculum reframes this not as an event, but as a three-stage process: compression, base, and expansion.
This is so crucial, especially for counter-trend attempts. The system demands what they call the first higher low rule. You cannot buy just because the price looks cheap. You have to wait for compression, the ribbon braiding, then the base price consolidating, and then the beginning of expansion, which is confirmed by that first higher low.
If the first four parts define the quality of the swing, this section defines the profitability. We have to start with the system's core philosophy, which is a massive psychological hurdle for most traders. Entry is not the edge risk control is. That statement is profound, isn't it? Most people spend 90% of their time trying to perfect the entry, which might only account for 10% of the outcome.
It's all about expectancy. The mathematical reality of trading. The formula is clear. Your average win times your win rate, minus your average loss times your loss rate. A trader can have a low win rate, say 40%, but still be highly profitable if their average win is just way bigger than their average loss.
That edge comes from ruthless downside management.
Which is why the system provides structurally based stops focused entirely on the SMA50 shield.
Okay.
The logic for the MA50 shield is simple. The MA50 is the boundary that separates a healthy, normal pullback from a deeper, potentially fatal breakdown. The stop is placed structurally just below the MA50 for longs.
That structure alone isn't enough. You need some margin of error. The system includes a precise way to do this, placing the stop guide with a small percentage buffer, which defaults to 1.5%. Why that specific buffer?
It's noise dampening. If you placed your stop exactly on the MA50, everyday volatility could easily take you out of a good trade. That 1.5% buffer acknowledges that prices often pierce key levels temporarily before they recover.
I see.
If the price falls below the MA50 and continues 1.5% further down, the structural integrity is definitively invalidated. The assumption that the trend is healthy is broken, and the system demands an instant exit.
So stops are structural. Now, for the exit, once you're in a trade, the system demands consistency. It says pick one exit system and stay consistent.
This is another huge psychological test. The primary structural exit is the simplest form of failure, a close below the MA50 for a long trade. If that happens, the medium-term health is gone, the trade is closed. But it offers style variants for trailing profits.
Let's debate the two options. Option one is the SMA-20 trail. What kind of trader or market is this best for?
The SMA-20 trail is for aggressive trends, or for traders who prioritize faster profit capture. If a trend is really strong and has shallow pullbacks, it's excellent. The moment price fails to hold the MA-20, you're out, locking in profits quickly.
But the downside is you might get shaken out by normal volatility.
Right. But if I use the SMA-20, I know I'm going to leave a lot of money on the table when a massive parabolic swing happens, because that swing will eventually breach the 20 and pull back deeper before continuing. That's where option 2, the SMA-50 trail, comes in, isn't it?
Exactly. The SMA-50 trail is designed to capture those bigger swings. It accepts way more volatility. The trader has to be willing to endure deeper pullbacks, even losing back some profits, as long as that primary swing structure, the MA-50, is maintained.
And that brings up a massive psychological issue. How does the system account for how hard it is to give back profits when you're using that SMA-50 trail? Seeing your P&L drop 15% from its high can just shatter your discipline.
That's where the rule integrity oath comes in, which we'll get to. But practically, the system includes exhaustion warnings for this very purpose. These are optional signals triggered by the fast MAs, like a 5-10 cross or the close crossing the 20, while you are still in the main regime.
So I'm in a long trade, I'm trailing the MA-50, the price pulls back, and the MA-5 crosses below the MA-10. My main exit hasn't been breached, but the fast momentum has turned negative.
That's an exhaustion warning. It's designed to prompt you to protect your capital before the structural failure fires the main exit. It's a signal to maybe scale out some profits, reduce your risk, or tighten your physical stop just above that MA-50 buffer.
It's an intelligent way to manage trend maturity and fight that psychological difficulty of watching profits disappear. It gives you a system-based reason to take some money off the table.
It just reinforces that every single decision, even a partial exit, has to be rule-based, not emotional.
Exactly.
Okay, moving from theory to real-world deployment. The T-KIFE system uses the ribbon not just for triggers, but as a complete model for dynamic support and resistance.
This is where that structural definition really pays off. The medium MAs, the 20, 50, 90, 120, are defined as dynamic shelves. They are the calculated levels where price reactions are just statistically more likely to happen. The ribbon acts like a constantly moving, self-adjusting Fibonacci tool.
And when those shelves align closely, the system flags what it calls confluence zones.
A confluence zone is when MAs like the 50, 90, and 120 cluster together when they're within a very tight range. These tight clusters create a fortress or a real wall, and price reactions at these dense zones are often violent and very reliable.
So how does identifying a fortress zone help a trader practically?
It just increases your confidence level for both entries and stop placement. If your pullback happens right as price is testing a 5090-120 confluence zone, the probability of a violent bounce is just drastically higher. And conversely, if price breaks through that zone, you know the breakdown is significant and you need to get out now.
And the power of this is that all these rules are digitized and adaptable. They offer implementation tools to automate this entire checklist.
Yes. For TradingView users, they have the Pine script that visualizes everything: the ribbon, the score, the regime badge. For Thinkorswim users, they supply the ThinkScript logic for signals and custom scanners. It eliminates the excuse of manual charting.
I found the inclusion of the Google Sheets template particularly accessible.
Absolutely. The template uses the simple Google Finance function to pull data, and then it just runs all the T-KIFE calculations right there in the spreadsheet. It lets users, even without a coding background, maintain an objective scanning and journaling system.
But the curriculum really emphasizes that implementation is nothing without validation. They stress backtesting and integrity to avoid the curve fit trap. What does that mean here?
Curve fitting is when you adjust your parameters until the system looks perfect on past data, only for it to fail miserably in the future. T-KIFE fights this by requiring fixed, objective rules and a focus on metrics that matter: expectancy and drawdown.
Right.
They explicitly warn against chasing high win rates, which are often a sign of a fragile system.
And this philosophy is backed up by that academic reading list they provide with guys like Robert Carver and Ernest P. Chan.
That reference list is the integrity check. Carver and Chan, they emphasize robustness, out-of-sample testing, keeping your parameters stable. The T-KIFE system is built to be testable precisely because all of its rules are objective, mathematically defined conditions. There's no ambiguity.
So ultimately, the system is designed to remove the trader from that exhausting, continuous decision-making process. It replaces chaos with the T-KIFE workflow, a structured daily routine.
And that routine is what they call the edge multiplier. It's a clear three-step daily process. Step 1, pre-market. You scan using the regime, structure, and score filters. You make a short list, and you plan your exact entry and stop-loss points.
Step 2, during market. Your execution has to be alert-driven, using that highly specific alert logic. Your job is just to execute the pre-planned trade when the conditions are met. No emotion.
And step 3, post-market. This is crucial for discipline. You log the trade, screenshot the structure, and you perform the 3 mistakes audit. Did I trade chop? Did I trade against the regime? Did I ignore my exits?
It's a complete operating framework where discipline, enforced by that routine, is the final component.
It is.
This has been a really deep dive into systematic rigor. We've seen how King-KAMBUF took this concept of a multi-layer moving average ribbon and turned it into a complete market structure map. It's a regime identifier, a chop filter, a trend scorecard, and a precise execution system.
And the value here, it really transcends the technical rules. It's in the foundational understanding that successful trading is a quantified process, and it's governed by structure. The depth of this curriculum, from the specific 120-200 regime pair to the mathematically defined braided ribbon, it's all designed to enforce one single thing: rule integrity.
Which brings us to our final provocative thought, drawn directly from the philosophy that underpins this entire system: the rule integrity oath.
If you, the trader, adopt this framework, if you truly commit to stopping the chase, avoiding the chop, and only executing when that structure, the ribbon score, and the trigger perfectly align, your greatest challenge is no longer reading the chart. The chart becomes clear. The greater challenge is upholding the contract you made with your own system. When you look at your training journal at the end of the year, will your performance be dictated by the market's unpredictable moves, or by your consistency and discipline in following the ribbon's clear, uncompromising structural law? The system provides the map and the rules. Your adherence to them provides the destination.